Oil prices have fallen dramatically since June, with one forecast seeing $70 a barrel oil on the horizon. Joining us now to examine what's behind the drop and the economic and political consequences that could arise from the fall. In Calgary, Alberta via Skype, Jeffrey Jones. He's a reporter with the Globe and Mail. And with us here in studio, Don Cox, chairman at Cox Advisors LLC, Armin Yalnizyan, senior economist at the Canadian Centre for Policy Alternatives, and Elena Cherney, Canada Bureau Chief and Global Resources Editor at the Wall Street Journal. And while we are happy to welcome everyone to the program, Elena, I want to really welcome you. This is our first time here. And Jeffrey in Calgary, a special welcome to you. First time here as well. So thanks all of you for coming. And let's get this on the record right off the top. We got charts. You want to see charts? Watch the monitor here in the studio. Sheldon, let's bring this up if we can. We're going to compare some oil prices. This we're calling plummeting prices. This is all U.S. dollars. The type of oil, and then June over October comparison. Here's Brent crude oil, 115 U.S. in June, now down to 85. West Texas Intermediate, $105 a barrel back in June, now $85 a barrel. Western Canada Select, $87 a barrel in June, now $67. And if you consider the Canadian dollar is worth only whatever it is, 80 some odd, 85, 86, 87, 88 cents US, that looks even cheaper. One of the things we want to figure out is, why is this happening? Jeffrey, I want to start with you, and then let's go around the table. I'd like to get one significant reason from all of you as to why you think this is happening. Go ahead, Jeffrey.
Well, I think one of the major things that's happened with the oil market over the last probably 3 or 4 years has been this explosion in U.S. light oil production that nobody saw coming as a consequence of the shale drilling boom. And we've seen huge increases in production coming from North Dakota and Texas. And what that has done has changed kind of the global supply picture, in that the U.S. is no longer it no longer needs the type of imports from OPEC countries that it once did. And now those OPEC members, such as Algeria and some other countries, are forced to fight it out amongst themselves in other markets, and specifically Asia. And now we've seen a fight for market share in that all-important part of the world.
Okay, fracking being one very good reason. Armin, what would you add to the list?
Well, I'd have to agree that supply is the big story here, but the other side of supply is that demand has stalled out, admittedly at record high levels, but it's not growing the way it was. So in addition to stalled out or faltering growth, you're having this influx of supply from the baby drill states and from Libya, from Canada, and OPEC, as we just heard, and their reasons behind it. So you've got more supply, stalled out demand. It means falling prices.
Elena, what would you add?
I would just build on that a little bit and say that I think what Jeff is describing is this really interesting butterfly effect. You have a drilling in North Dakota, and that, in a sense, displaces imports, for example, from West Africa into the U.S., and that, as Jeff describes, creates this fight for market share in Asia and Saudi Arabia's behavior in cutting prices there. And that's very different than what we might have seen some years ago, when really there were fewer levers, fewer big factors influencing those global patterns. Now you've got China growth is a big one, U.S. production was not the factor that it is now, and Saudi Arabia remains.
Don.
Well, as a free market economist, I'd love to make it unanimous and say, yep, it's just supply and demand.
But
the most disastrous aphorism to come out of the Middle East in our lifetime was when the Shah of Iran said, oil and politics don't mix. He didn't last long after saying that. What we're seeing now is the mixture of oil and politics, which could not have come along to this degree had it not been for exactly what the panelists have commented on.
Who's oil and who's politics?
Saudis and the other major Gulf states who are faced with an existential crisis occurring, starting in Syria, now on with ISIS. And this is their opportunity to cut the cash flows to the big backers of Assad, which is Iran and Russia. And they can do it at very little cost because of exactly what everybody else has commented on. So the Saudis, who went terrified, I've talked to some of them about this, about what this could mean, Iran getting the bomb, and here they got a chance for just supplying a little extra to their refineries in Texas, where along with Royal Dutch Shell, they're #1. And they can have this marvelous impact cutting cash flows to Putin and to Iran. Fabulous.
Got it. Okay.
If I
Please.
might, just in terms of an additional existential crisis moment, which I love that concept of what's happening geopolitically, but also technologically, we're facing a moment of real transition from reliance on petrofuels, which we just heard earlier this week. We're looking down the barrel of climate change concerns, where solar price unit prices for solar energy are now rivaling that of coal. We are looking at a massive shift in possibilities of where we get our energy from. So growth is less tied to fossil fuel production than at any time in the past, and we're looking at a categorically different future. So we're seeing temporary and transitional issues combined with long-term structural change for a real whopper of an effect.
Jeffrey, you're in the heart of Canada's oil patch. I wonder if you could tell us whether anybody you talked to there 6 months ago, 12 months ago, saw this coming.
You know, a few people saw sort of an end to the kind of volatility that we've seen in the oil markets for a while, but I think what they saw was an end to the volatility to the upside. Now what we have is incredible volatility to the downside. So I think there were a few voices in the wilderness that were calling for this type of situation. I don't know if it was to this degree. I think probably one of the most stunning things that we've seen with regard to the oil markets now is if we would have had the type of military situation, violent situation that we have now in places like northern Iraq, like Libya, like Eastern Europe, we would have seen oil prices spiking off the map. And that's just not the case anymore. I think that shows just how much the landscape has changed.
Let me follow up with Don on that, because it has always been a truism that when the Middle East is in chaos, oil goes through the roof. And yet we are seeing Israel and Hamas just fought a war. Israel and Iran look like they're about to go to war. Libya is a mess. Syria is a mess. IS is out of control. And yet the price is falling.
That's because of fracking. Because if we had not had the frackers, then we would have seen $150 oil. You're absolutely right. But this was the deus ex machina on this, that a whole bunch of oil companies you've never heard of before got together, figured all this out, and they supplied this, which interrupted all these neat arrangements where you could assign the world's supply and demand among the existing players going way back when. And so this eruption, as it were, into it created the opportunity where what you could have then is all these geopolitical crises going on and oil prices not going up. The Saudis then, seeing that, saw, aha, it doesn't take much that we do. The small price cuts that they've done, particularly the refineries in Texas, should have had only a pinprick effect. This is a beautiful example of when you've got supply and demand in dynamic balance and all sorts of things going on, and then you hit them. I mean, ever since their notice went up, they're 85. We're at 77 now. I mean, this is really spectacular. And therefore, what this does is it really is a tremendous blow to Iran. Russia is now making a deal to buy uranium from Iran. They were buying oil from Iran. That was, I think, the final thing that got the Saudis. What does Putin need? He doesn't need more oil. He's trying to sell
tons,
it.
yeah.
He was buying oil from Iran to pump money in there. And so the Saudis said, look, of all the people who want to have win out of this, it's certainly not those Shias. We've been fighting them for 14 centuries. So it doesn't cost the Saudis much to do this. They have to be cackling there. In all the time they've tried geopolitics before, they've never had such spectacular results.
One of the things I am trying to get a better handle on is and again, I don't know, Sheldon, I'm throwing you a bit of a curveball here, whether we can go back to that chart we had up at the very beginning here. I'm noticing that the price per barrel, if you compare, for example, Brent crude oil and West Texas Intermediate, they're both around $85 a barrel. Look at the top right there of the screen, 85 and 85. And then I see Western Canada Select down at 67. Anybody got any theories, Elena, about why that differential is in place?
So there's always been a differential. Western Canadian crude trades at a lower price compared with West Texas because it's heavier, it requires more refining, it has always traded at a discount. What's actually really interesting about that chart is that the gap between the Canadian crude and the West Texas price has decreased over time. So we're seeing a $30 drop in the price of both West Texas and Brent since June. Actually, it's more than 30 as of today. but the Canadian price has only gone down by 20 relative to West Texas. So in other words, that's the discount at which Canadian crude from the oil sands, for example, or any Canadian crude trades to U.S. crude, and we're being punished relatively less, in a sense, by the decline.
How come?
Well, part of that, I mean, there's the fact that heavy is always more protected. There's been greater supply that's been able to reach the U.S. refineries. That has to do with the transportation issue and the growth of rail. So more Canadian crude, there's less of a glut than there has been historically at some U.S. choke points. And more Canadian crude is able to actually get to market, which decreases that differential. The Canadian dollar is also protecting Canadian producers at the same time. So even though it looks like the Canadian price is even lower, if you were to translate into US dollars, yes, Canadian producers' input costs are in Canadian dollars, and therefore they're selling at US dollars, and that also helps them.
Interesting. Okay, got it. Armina, it always feels, could be wrong about this, but it feels like oil is one of the most unpredictable things in this world, commodities to price. You just almost never know when it's going to go up, when it's going to go down. Jeffrey was telling us earlier there aren't too many people who saw this coming. So on a scale of 1 to 10, 1 being, of course we knew this was going to happen, 10 being, my goodness gracious, the sky's falling, can't imagine this happening. Where do you see oil right now on that continuum? The price changes.
Oh, I don't know going forward, but can I just say, I remember going to a Bank of Canada meeting not long ago, about 2 or 3 years ago, where their forecasts were dependent on a scenario fan of between, I think it was as low as $60 a barrel and 180. And they were trying to figure out, well, where are we heading? So you can bet your booties that the smart people know that it could go anywhere. It could go sideways, it could go up, it could go down right now. The chances, as we heard, are now on the downside of the volatility equation for all the reasons that we're talking about. But what's fascinating is that governments have priced in their budgets at a certain dollar a barrel value. And at the federal level, I think we're going to get hit harder than at the Alberta level. We've been announcing billions of dollars, annual dollars, in tax cuts before the surplus has even arrived. We had a $3 billion cushion. That was blown out of the water last month when the prices had fallen by 25% for crude oil. They've now fallen by 33% as of today, as we mentioned. Liquefied natural gas has fallen by 17%. Natural gas has fallen by 17%. Those two, oil and gas, account for 6% of GDP, and their share of the economy has been growing. So, step one, more volatile prices. Step two, less investment because of dropping prices. Step three, slower growth. This is starting to get baked in, and we're going to have a very unpleasant surprise, I think, on the other side of the election at the federal level, where we discover we didn't have as much money as we thought. The cupboard is more empty than we thought. So, Jeffrey, the income splitting announcement, for example, that the Prime Minister made the other day, he shouldn't be so quick to spend that dividend because if it keeps going this way, that money's not going to be there. Is that fair to say?
Well, it depends on what kind of numbers are baked into the budget. I mean, if you take a look at Alberta, for instance, yes, they're getting hit on the oil side to some degree. But if you look at the overall budget, when it comes to the dollar, when it comes to the various types of crude, when it comes to natural gas, they're only, a few percentage points below where they figured they would be. Right now. Actually, they were way above back in the summertime. I mean, natural gas prices were higher than expected, oil prices were higher than expected. So, I mean, it really kind of depends on when they decide to kind of restack the deck and decide, okay, well, this is an affordable program and this isn't an affordable program. But it does show how important the oil has become to this national and provincial economy. I mean, it's more than it has been in the past, and it only seems to be growing in terms of importance.
Okay, I'm getting ahead of myself a little bit here because I want to come back to Canada later. Let me refocus now on the international situation. Elena, even though global demand for oil has fallen over the last few months, I note OPEC is not curbing its production, which it has done in the past in order to try to get the prices back up. Why isn't it doing it this time? Well,
I think that goes back to some of what we were talking about earlier on, and that's a fight for market share. And again, you could really look all the way back to the fracking revolution and the wells that were drilled in Texas a decade ago when people figured out how to get oil out of rocks that you previously could not access. And that has created all of this new supply. There was one CEO last week, the CEO of Exxon referred to a new era of energy abundance. So you could think about what Saudi's doing really as a response to and an effort to cope with a new era of energy abundance. But that's if you believe that supply and demand are the critical rational factors in Saudi Arabia's behavior.
Well, that's a long way from the days of the sky is falling, peak oil is upon us, you know, let's go hide in our caves, right? I mean, I don't hear that much being said about that anymore.
Well, we see another example of all this, and oil and politics don't mix, with the Canadian-U.S. situation. You know, about the time that Keystone was first discussed, they were at CERN. They were trying to discover about the beginning of the universe. Okay. Well, CERN solved that problem. We're still not solved Keystone. And so now, why is that? Well, this is a classic example where pure politics in the U.S., which is impure politics, got in the way. But then there was a response. The oil sands company started getting trains. They got the train cars, and all of a sudden, just as much was coming out and going into the U.S., and it was taking up space that the farmers needed when they've had 2 bumper crops in a row. So the impact on this on American and Canadian farmers has been extremely painful, because the actual, you don't take the prices that grains are trading at on the Board of Trade, the actual basis the farmer gets now is about 60% of that price, because they can't get it anywhere, because it's taken up by the same trains which are traveling through cities, occasionally setting them on fire, and that's all happening because Obama wouldn't let Keystone go through. Perfect example of when you let oil and politics mix together, it becomes a disaster.
Don, I have a booker from the Letterman show on the other line who wants you on the show right after we're done here tonight. That's good. Sorry, did you have a follow-up on that?
Oh my God, I'm still like bathing in the apocalyptic glow of your guest.
That's pretty cute. All right, I almost don't know where to go after that, Don. That was a stunning performance. Okay, let's try this. Okay, Jeffrey, you come on in.
Yeah, sorry, I just might wonder, it may not be quite as entertaining, but I will mention that as far as OPEC goes, we'd probably be remiss if we didn't mention that there is a major OPEC meeting coming up at the end of this month. So while this game of chicken is going on with regard to market share and prices, there are, I mean, all eyes in the oil world are on that meeting and whether OPEC can come together as a group and agree on some kind of production ceiling to prevent this crude price from falling off the cliff.
Let me do another, Ellen, let me start with you on this one. Just a climate change follow-up here, which is the 4th and final volume of the IPCC, the Intergovernmental Panel on Climate Change. Their assessment report was published this past weekend. The message is pretty clear, as it has been over the past 3 reports, that human beings are at the center of the climate change that we are experiencing right now, and we need to do something about it, or else the temperatures on the globe are going to continue to both rise and be unpredictable, and weather's going to be more severe. We know the story, etc. You talk to people in the oil patch. You talk to people all around the world in the oil business. Does that message resonate with anybody in the oil industry today?
Well, I think it really resonates when demand declines the way that it has. I mean, that's a very, very strong signal, and that's part of the reason that we're seeing the decline in demand, is because we're seeing an increase in efficiency, and that is having an impact on how much crude is consumed, both in terms of consumers, gasoline, and input costs in other parts of the economy. So I think that is heard very loud and very clear, and maybe the strongest signal that the industry is getting.
Armin, how about it?
Well, I think it's absolutely leaking because of divestment. So when the Rockefellers, who made their money on oil, say, bye-bye oil, this isn't a good long-term bet
Just explain that. Explain what you mean by that.
So John Rockefeller made his fortune on Standard Oil. And his family foundation was formed, I think, in the 50s or the 60s or something, and they have a huge amount of money invested in oil, and they announced about a month ago, I think, that they were divesting all of their investments that were in oil. They're going to sell by the end of this year, 2014.
It's astonishing.
Like within a few months, they're going to get rid of it all, which was, at least all the Canadian oil sands stuff is where they started off with, in the name of climate change, in the name of this is not what investors should be doing, investing in things that makes the planet impossible for business to operate. You can't have successful businesses on a failed planet. And now we're seeing, some kind of ripple effect. When you get that kind of a headline, then other investment funds, particularly pensions that are dealing often with, teachers and public servants and stuff like that, wanting to make sure they're making ethical investments for their pensions, then you start looking at a kind of snowball effect. In fact, they referred to it as starting a snowball effect.
Don, what do you hear in terms of whether the industry is waking up to this?
Well, those Rockefellers, third generations down, are people of very little distinction other than having the name Rockefeller. And so this doesn't prove anything about the fact of a change in mind. Global temperature stopped rising about 15 years ago. We haven't had a hurricane in Florida landing in the last 6 years, and we're told the weathers are more extreme. We had a really cold winter last year. We may have a cold one. So you can say we are getting more extreme weather. That's possible. But in looking again at oil and politics mixing, what you got to say is, where does the wealth being created? And so, yeah, developing alternatives is absolutely necessary because we're going to run out of fossil fuels at some point. Not at the point that perhaps the enthusiasts want it to happen, which is tomorrow. But we need to do that. So all of that is a good thing.
Don, you're a climate change skeptic. I can see that. You are a climate change skeptic on this, aren't you?
Well, I am a skeptic on lots of things, okay? And when you see that since the sunspots started to go away, and since NASA has admitted there's an 81% correlation over the last 4 centuries between the level of sunspots and temperatures on Earth, what you got to say is, well, let the astronomers get into the debate. After all, it may surprise people, but we actually get our heat from the sun, not sort of from the Earth. So we'll see about that. But again, what you need is a balanced study on all of this. What I've been citing as examples, this isn't as bad an example as the others, where what we've had is clashing motivations and leading to spectacular results like a collapse in oil prices. We need all of the above in energy. And certainly what's happened now on Keystone is an example. Look, I was general manager of the Ontario Federation of Agriculture and general counsel of the Canadian Federation of Agriculture. What's happening to the farmers because of this really offends me. And that was created by bad politics. So that's the kind of thing that does upset me. All right? And I think...
Sorry, your reference to what's happening to the farmers is a reference to...
Because of the fact that the oil sands companies were forced into using trains. And that led to this. And you see, anybody with any imagination would have said, well, look, there's only so many tank cars and so many rails. If we're getting this much stuff coming out, and then the frackers in North Dakota got on board with that because they couldn't build pipelines fast enough. So what we had was this unintended effect. And the law of unintended effect is one law that almost never seems to get repealed.
Gotcha.
So I am much more concerned of looking at in the whole commodity universe that we need a balance on this. And I guess my real sympathies lie with the farmers in this. They are the innocent victims of misconceived policies.
Okay, let me go to Jeffrey. Again, have you heard any chat in the oil industry from where you are at the capital of it in Canada that they hear what the IPCC has to say about climate change and they intend to change or react to it in some way?
What I've heard specifically from the Alberta government is that there may actually be some kind of policy change coming as it relates to carbon, and about time, really. If you take a look at what had happened, Don talked about Keystone XL, and yes, it has been delayed, but it has been delayed also as the debate has raged about Alberta and carbon emissions, and at the same time when former Premier Alison Redford went down to Washington so many times to say that Alberta is an environmental leader, and ended up not making more stringent policy on carbon. It's a social cue. It's a trade issue. So I believe that Jim Prentice now, as Premier of Alberta, has to take a second look at what the oil sands contributes in terms of carbon, what the rest of Alberta's fossil fuel industry does on carbon, and make some kind of show of the fact that yes, we're hell bent on being energy leaders, but along with that, as he says, we're also going to be environmental leaders. But of course, the proof's in the pudding there.
The proof of the pudding is in the eating, I think is what they say. Yes. Elena, let me try. Let's come back to Canada now, and I do want to follow up because I know you were in Calgary not too long ago. Is that right? Mm-hmm. Okay. We are at a point right now where we seem to have more energy alternatives than ever before. Fracking is here. Solar and wind, Ontario certainly has gotten into in a big way. The price of oil is going down. Give us a sense about what the mood in the oil patch is like right now, given oil's not ascendancy, descendancy at the moment.
Okay, well, to be fair, I was there before the sort of collapse, actually the week before, great timing, and talked to a bunch of really interesting people about their projects. I think one of the great concerns over time has been cost. And in some ways, for oil sands producers, we saw even earlier in the year a couple of deferred investment decisions or shelved investment decisions, including
because the cost of oil is too low.
No, because of the cost, the rising cost of investment, rising cost of production, essentially. Gotcha. So Total, which is a big French-based company, put on hold a project to expand, and that was viewed as really a sign that there was some hesitancy about the ability to make economic expansion decisions given the costs. So I think it's really important, and I'm sure Jeff can add more to this, to remember that in the oil sands, there's not going to be an instantaneous reaction to a swoon in the price of oil. That for people to really pull back, because these are such long horizon, multi-billion-dollar projects, the projects that are currently producing have already been, the investment has already been made. The question is going to be a couple of years down the road for a lot of these companies, if prices remain low, do we continue investing more and more to increase production? Not so much, do we pull back production next week or next year, because it doesn't really work that way.
But 2 years down the road, if the oil sands are, if oil's at 67 a barrel, are the oil sands economical with that kind of price per barrel?
I think 2 years down the road, if oil is at $67 a barrel, that's going to be a very serious and very different conversation than it is now. And it depends on which producer you are, but I think that's going to be a very difficult conversation.
Jeffrey, do you want to add something to the mood of the city that you're in right now because of what's happening?
Well, absolutely. No, it feels quite like the air has come out of the balloon a bit. We had almost a booming situation for the first half of the year in terms of commodity prices. We saw all kinds of IPOs for the first time in a while. We saw all kinds of stock issues, mergers, acquisitions. It was fun times in the oil patch again. Now, in the last 4 months or so, it's almost like night and day. And with regard to the oil sands themselves, yeah, we've seen a few projects shelved now. Elena mentioned Total's project. We saw Norway's Statoil put the brakes on another expansion of their oil sands project. And as she mentioned, the other issue here will be what kind of oil sands production we're talking about. I mean, you can see that we've, as the Globe and Mail, our report on Business Magazine, dedicated an entire issue to the oil sands. It just was published last week, and what we've shown is, that when it comes to mining oil sands, the old school mining, trucks and shovels and all that kind of stuff, that takes, for expansion, that takes oil prices of a much higher level than today. The type of production, the steam-driven production, less so. So, I mean, there's a whole spectrum of potential outcomes as oil prices stay low. But certainly the mood here is one of trepidation.
And certainly, I mean, the pipelines have been a huge controversy for the last several years. But if, again, there's that first chart, we're at 67 US dollars a barrel for Western Canada Select right now. If 2 years from now, we're still at 67 a barrel, was it much ado about nothing? You don't want there's no need for those pipelines at 67 a barrel, I presume.
That is a huge discussion about whether we're having a fight over something that was a 20th century story, and now we're firmly in the 21st century, and the whole energy cocktail mix is changing. Don't forget, in Alberta, it's not just how we produce oil sands. They're at the front edge of developments, tech developments in solar in particular, through their collaborations with universities. So the question is, how do you translate a boom-bust economy based on oil into something that diversifies your energy strength? And instead of focusing on energy east, part of what we could and should be doing as a Canadian energy project is looking at how we develop energy least. You know, every growing economy is looking at how to minimize their input costs for energy and being more efficient. And we are in a cold country where we travel a lot to do anything to get product to market or to get people to jobs. Any of that requires a lot of energy. We should be at the front edge of what the world can do to minimize its energy requirements. And I think that's part of what it means to be an energy superpower in the 21st century.
Can I get you on this issue of at 67 a barrel, whether you even need those pipelines to begin with?
Yeah, I think that first of all, it's hard to see 2 years into the future. I guess I would think about pipelines not just to the U.S., but pipelines to the coasts. If, in fact, I don't know that we want to continue selling energy, but if energy is an important part of our economy, it is a critically huge export. I saw a projection that it could represent 27% of Canadian exports by 2025. That is before the current collapse or the current pricing problem. It would be difficult to replace that in other sectors of the economy quickly. So assuming that we are going to continue to be in the energy business as a country, we need to be able to get it to market. We need to assume that there will be markets. Right now people are duking it out for markets. Presumably Asia would be one of those markets. I do know, I mean, I think that there's a great deal of effort now going in at the industry level to get those pipelines built so that this landlocked crude in Alberta can find its way to either coast and potentially to the Gulf Coast for re-export to particularly Asia.
So you think we still need those even at 67?
I think it's a pretty good argument to make that we probably will need pipelines if we want to continue to sell oil.
Don.
I've got to distinguish between the question of building new oil sands operations, which require gigantic amounts of money, and those that are there now. Suncor can be pumping out oil at $50 a barrel and making money on it. Look, the big boom right now in fracking, the biggest one is the Texas Permian Basin. That's been going for 100 years. And it had all faded down. During most of that time, the average price they got was $3 a barrel, okay? Now they dunk down below and they discover with fracking that they found another new Permian Basin right there. All right, but the point is that the projects that are already on stream, generating cash flows, creating jobs, causing problems for transportation, which we've talked about, they will continue. But these cycles will be such that what you're going to do is defer what Total was doing. As an example, that they're saying, well, we got some other projects, some big high-profile ones. I mean, look, they've spent 16 years trying to get production out of the Caspian Sea. 16 years. They've poured $4 billion in there, haven't got a dime back.
This is Total?
Yes. So therefore, what they're looking at is saying, let's get this, because the Caspian has more flowing oil than we have in Alberta, flowing oil, if they can get it out. So this is an illustration where with what's left of what used to be the Seven Sisters, their priorities, by the way, they're less and less of a factor now. Lawsuits are basically getting rid of BP, and you go through, they're not as big a factor. So it's all sorts of new things that have to happen. And so I have no doubt that we're going to continue to be pumping oil out of the oil sands past the lifetimes of everybody at this table. That may cause more concern for you than it does for others, but that's already baked in. It's there. And what this will mean, if we don't build the new ones, it's going to lower the cost structure. Friends of mine who were responsible for hospital fundraisers in Calgary were bitterly complaining about the cost rising dramatically because of what's happening to plumbers, electricians, and pipe fitters because of opening new oil sands projects. So let's separate out whether we need to have breakneck development of new projects, but what we got to find out is a way of getting what we are producing, the sunk costs, where all that blood, toil, tears, and sweat came in, And that was problem, I think, is going to be resolved by American voters today. Because if he had any doubts about it before, what he's going to have is the American Farm Bureau Federation calling him up in 2 weeks and saying, you got to do something.
This is Obama you're talking about, I presume.
Because if you build that pipeline, all of a sudden, that will guarantee future crops will have access to trains.
Let me get Jeffrey on this as well. What are you hearing in terms of the imperativeness or not of building those pipelines if oil is at $67 a barrel?
I have not heard a single oil man say we don't need a new pipeline. And I doubt I will. I mean, because the issue of they call it market access has been job one for so many years. And there's something else too. I mean, we've been talking about a future of $67 a barrel oil, and I don't know if we can definitively say that that is really the future. I mean, there comes a point when, I mean, the old axiom goes, the best cure to low prices is low prices, right? And so there is a certain amount of crude that's going to be needed in the world. Once prices get low enough, they don't cover those costs anymore, and that will mean, you know, and this has happened so many times before, that oil prices start to go up again. I mean, well, we saw it on steroids back in the financial crisis in 2008 and 2009, where we had such a rapid decline in oil prices at this time, coupled with an inability to get credit, that there was something like $80 billion of oil projects canceled within 4 months, 5 months. I can't remember what the exact date was. Within a year after that, there was a slow uptick in the economy. It started to improve a little bit, and then before long we had oil up at $100 a barrel again. So who knows when that might happen this time, but I don't think we're locked into $67 a barrel for the next 2 years.
With less than 2 minutes to go here, let me try one more thing. Admittedly, Stephen Harper represents a Calgary riding, Elena, and you got to get elected in your home riding. Has he put too many of his economic eggs in the oil sands basket?
I think he'd probably find some people who would say he didn't put enough, in that it's taken a long time to develop some policy and to develop a framework for building these pipelines. I think industry is frustrated at how long it's taking, and certain projects, particularly LNG, are probably now at risk.
Liquefied natural gas?
Yes. That's also a provincial issue, but I think there are a lot of people who would argue that not enough has been done at a federal level to ensure that that infrastructure planning actually has happened to support the industry.
That's something you don't hear too often. How about you, Armin? Too many eggs in the oil sands basket for the Prime Minister?
Yeah, I'd have to say yes, in the sense that this is super low-hanging fruit from an economic development prospect, but we are faced with remarkable challenges coming down the road that oil and gas cannot fix. He's had a very long term in office now, and he really hasn't had an economic action plan that puts Canada on a strong path as the population ages, as it will, very dramatically in the next 20 years. And just banking on oil and gas, which is a boom-bust economy, as we've heard, isn't enough to prepare us for the future.
I want to thank all of you for coming in tonight and helping us out with this. Jeffrey Jones, whose work in the ROB magazine this past weekend, I would certainly commend to anybody. Jeffrey, that was a really great product, and congratulations on that. Thanks for being there from Calgary for us. You're with the Globe and Mail. Don Cox from Cox Advisors, LLC, Armin Yalnizyan from the Canadian Centre for Policy Alternatives, and Elena Cherney. First time on the program. Well, it was okay, wasn't it? It was fun. It was, admit it, you had a good time.
It was great.
It was great. Okay. From the Wall Street Journal. Thanks, everybody.
Support Ontario's public television. Donate at tvo.org.